So I haven't said it in a long time, and I know people are asking why, but we'd really appreciate it if you like, share, subscribe. Your support is appreciated, and anything that you can do to help us obviously grow our audience would be appreciated. So interesting things now. Some of the headlines coming out, Saudi Aramco commentary is interesting in general when you look at what is being said. So just to give you the exact quote in terms of what has come out so far. And again, it's just, I don't think it's any surprising. Saudi energy minister, a good chunk of the tightness today that we see is down to some sort of scaremongering. There's always this human thing, the crowding effect kicks in and panic buying picks up. But that was prefaced with, what was said prior to. We've asked ourselves deliberately what we can do as an additional contribution to mitigate the situation. Unfortunately, for the first time, we see our role extremely limited because the issue is not the availability of crude. And Saudi energy minister also said, even if we made the crude available in tons and tons, who is going to burn it? Where are the refiners that will convert it? And who is in need? Are they in need of crude or gas? And I think that kind of drives home what we've been saying, especially in this segment. When you look at the paper market versus the physical market, where there are physical barrels available. There is no shortage of physical barrels. Now, we're starting to get some of that coming back. We have India coming back. They've put out a new tender. We should get more information. The hope was that they were going to pull more from West Africa. They ended up pulling more from the Middle East because the Middle East undercut pricing just because there was a lot of floating barrels that were expected to be floating and currently floating. We saw some of that clear. So now you have China that has issued some additional quotas. That has driven up the ESPO price. That's now at about $6 and the most expensive it's been in 24 months, while we have discounts in West Africa. So it's a matter of crude grade, where some grades are doing very well, some grades are doing very poorly. So it's just a matter of at what clearing price. At what price will a teapot refiner buy Nigerian? At what price will the IOC or Indian Oil Company buy Angolan? At what? There's always a clearing price. The question is, what is it? And is the buyer willing to go either up to that level, or is the seller willing to come down to where the buyer is? And that's where we keep having these moves because, and as we showed in segment 1, there is a lot of floating crude. There is no shortage on the water to take down some of this oil. And now I know Cairo's put out a new number for China that they've drawn down some of this excess that they built up in 2020, now back or just below that pre-COVID level. But as we keep talking about on the Shandong side, they were just below 2020 levels, and there's more crude sitting in the water. So how do you fix the paper market if there's the physical available? And are we seeing some of these prices go up to cover that excessive cost that has come into the refining process? Natural gas has increased. You have hydrogen prices that have increased. You have shipping prices that have increased you have to move it by diesel. So a lot of these different competing factors are coming in, which again leads us to point to where is that crude? Because when you look at crude oil exports, which increased 546,000 barrels a day, just above 3 million. We expect that to come back to about 2.8, 2.6, that normal kind of range that we have next week. But the PADD 3 has more than enough crude. I mean, we're at the third highest ever, on our way to the second highest ever of crude in storage in PADD 3. So there is no shortfall on the coast. There is a shortfall in PADD 2, and a lot of that is being driven by that shortage coming out of Canada, which, again, Line 3 is going to help reverse. But that's something that we continue to see, this kind of balance in the market of, obviously there's that movement of what is going to happen in winter. When does winter weather start? How many additional refined products will be burned to generate electricity, to generate heat? And these are some of these unknowns, and then you can drive a truck through some of these estimates. So again, these are things that have to be considered. Now, when we look at exports, you can see gasoline exports dropped 166,000 barrels a day. We continue to see an overhang for those exports in general. They will bounce, but again, you're just seeing that the depressed versus the 5-year. Distillate fuel oil down another 68,000 barrels a day. You're just not going to see the flow into the export market just because Europe is sending it to us and we are in a very bullish position for distillate. So why would you export it if you have a great market at home? And that's where we're going to continue to see that. As propane had a drop of 324,000 barrels a day in exports, but again, still well above the 5-year average. That's still going to stay strong. And then, as we said earlier, crude oil exports had an increase of 546,000 barrels a day, going from 2.5 to just over 3 million. And we expect it just to come back to kind of that range that we've been alluding to. So now when we look at refined oil product arrivals in Europe from the Americas, will continue to drop in October. Total fuel imports observed so far, 491,000 tons this month, including 4 tankers that have already arrived and 9 ships currently en route, which compares to 16 tankers that arrived in September. So again, you're just seeing a lot of these overhangs just because it just doesn't make much sense. Now on the other side, fuel oil flows to Asia from west of Suez markets are set for a 6-month high as European refiners seek to clear surpluses of heavier fuels. So again, this is what we keep talking about of the heavier shifts in general. The volumes that's set to arrive has reached a 6-month high so far in October. That's up 32% from 4.63 million tons compared with September. 43% was low sulfur, 44% was high sulfur. Asia imports of fuel oil from west of Suez markets such as Europe, Latin America, and the U.S. Stronger margins largely driven by gasoline and diesel have pushed European refiners to raise runs, which we continue to see. We are seeing the impacts of refiners simply overproducing fuel oil on the back of taking advantage of the lighter product cracks, which is pushing this excess in. So that's why we keep talking about how much is going to be available. So when you look at what is going to be available going forward, yes, there will be more gas oil, fuel oil burned, but how much is going to be available for winter? And we continue to see these ramp ups just because it's either a throw off in terms of what is actually being targeted, but that's where we continue to see Asia taking more fuel oil from Europe to help deal with some of those movements. And there's been a notable increase in shipments from Europe as the Atlantic Basin to the east is roughly the highest as in the past 25 days. So again, that is driving more going forward. And we just had a bunch of reoffers hit the tape because now there's even more available. So there's been additional reoffers as it was purchased. Now they're looking to flip it. And again, they're trying to make money. So this is an arbitrage. So you can buy it and now the market's gotten better. So you're going to go out and flip it and sell it back into the market. And you're going to see some of these additional movements. So you'll actually see even some of these boats reverse that were coming into the Atlantic Basin and actually head back into Asia, just given where the spreads are and where the market is telling it to go. Again, the market is going to set the clearing price. And if that better clearing price is now in Asia, I'll give you 3 guesses where that product is going to end up. So now when we look at crude, again, you can see that Dubai is, WTI still very expensive versus Dubai. It's gotten a little bit better, but again, you're still struggling to see this clearing price for the U.S., which is keeping some of that crude locked in pad 3. And the same can be said for Brent, which is why we continue to see these buildups in floating storage. Now, we have started to see some North Sea, some European crude start to clear, and it's actually at 5 cents better than it was. So you're starting to see some of that movement as Dubai, essentially India came through and cleared what was sitting there and was creating some of that overhang in Dubai. I should say not just Dubai because they took other grades as well. But when you look at what they did with the Middle East, and we'll want to see what do they clear or what do they take down in West Africa, because there is a lot of crude available in West Africa. And that's the other thing, when you hear this narrative of, well, OPEC is still producing below compliance, it's like, well, let's think about this critically. They can't clear reduced loading schedules. So why would you produce at the rate that you're allowed if you can't clear a reduced loading schedule? Because, I mean, think about it. If you reduce production levels, that's inherent storage. You're just leaving it in the ground instead of taking it out and then paying to store it in a tank or a boat. So yes, they're over compliant, but it's all driven by West Africa. West Africa is over compliant because they can't sell oil in the physical market. So they're opting to cut back on a lot of these production levels. So I think it's just a matter of, what are people listening to and how is that being driven going forward? And here's just looking at U.S. gasoline. We were expecting it to move a little bit higher just because this is where you normally get this increase in gasoline, and instead we had a down move. We expect to see this pop back into the bottom of the cloud. But again, you're just seeing this kind of slowdown in terms of that demand going into the open market. Distillate, again, it's just going to stay sideways. We're going to have a lot of headwinds going into the end of the year, just given where distillate storage is in the U.S. and how Europe continues to push more distillate into the market, more diesel into the market, offsetting some of these levels. Then when you look at ethane exports, we hit a new record of ethane exports into the market at all time. This is seasonal. This is 2021. Again, that's putting a lot of that additional bid in the NGL barrel and that natural gas liquid side, which is going to be very bullish for pricing. And that this is something that was missing in 2018, the last time we had this push up, which again is going to be very supportive of the NGL bucket. Now, when you look at total crude oil exports, we're well within the cloud. We're at the higher end. We expect this to fall down, staying within our normal range. And then when you look at crude oil exports, we're right within the middle of that range. It'll creep up closer to that higher end, but again, still well within the spread. Then you look at propane, fell back down, but still above the 5-year average. We're still going to continue to see this demand as pricing remains robust and global demand remains elevated. So then when you look at GENSCAPE, you can see that we had a build of about 1.1 million. That's, again, as we were saying, it's just going to go sideways. We don't expect it to come back to the 5-year average because there is that demand. You have seen an increase in runs, and you get some of that disconnect between when it shows up, when it goes through. The Rhine has gotten better, so you're seeing more product move through, more crude move through, move deeper into Germany. So again, those are things that are going to help pull some of this through on the tank side. Now, before we get into the rest of the segment, we just want to reiterate, because we filmed the EIA show on Thursday last week, we were able to pick up Singapore and Europe. So we just pulled it out, and we'll bring it back next week, just because the numbers haven't changed, because they change tomorrow. So there's no point in wasting everyone's time reiterating what we've already discussed. So now when we look at the loading schedule, you can see that we continue to push higher in October. We're at just at 11.91 million. Russia's been the biggest driver. That's going to remain elevated, and it's actually going to increase. We'll be above about 4 million as we head in, as they continue to announce November, and that'll be a positive when you look at the Mediterranean and keeping some of those prices a little bit depressed on the differential side, helping the refiners, obviously make additional margin. And then when you look at Nigeria has been fairly fixed at about 1.5. We should get their loading schedule for December by the end of this week, beginning of next week. Angola has taken it a bit up from November to December. In November is 1.087. December they're at 1.1. And some of that November was a deferral from October. Then you look at Norway still remaining elevated. Same with Nigeria at about 1.5. We see that being fairly sticky here as Libya has cut down a bit. But again, still staying at about 1.12, 1.13 is where we see them kind of hanging out in terms of where things are going, as Congo continues to struggle to sell not only just October, but also November. We should have more color by Friday on how much the IOC took. Now, as we said last week when we're looking at Fujairah, we did get the builds that we were expecting in the middle and heavy side. Light started to come down a bit, still elevated versus last week. But again, you're starting to see some of these, timing delays and what we've been talking about continue to play out week on week. So when we look at Fujairah, stocks rose 634,000 barrels with overall stocks up 4% week on week. Just a reversal from last week's draw. We continue to move that with obviously middle and heavy resid posting the biggest builds. So light disti fell 975,000 barrels. Demand recovery was reported in the Middle East and Asia as more gasoline tenders started to come out. Again, there was some excess in light. Now you're starting to see that move out into the system. And this is also, when you look at what the demand has been, Indonesia, India has seen their gasoline consumption increase, with diesel starting to come back a bit, still a little depressed versus 2019, but really starting to close that gap. The biggest concern now is price. Because a lot of these places, especially in the emerging markets, are a bit more sensitive to pricing, which is becoming some of that overhang that we're starting to see in the concern out of some of these regions. Meanwhile, when you look at market sources from PetroChina, petrochemical in northeastern Lyon province will cut product exports in October by 42% on the month to about 240,000 metric tons due to quota shortages, and export 80,000 metric tons of gasoline, down by 54%. A fire broke out in Kuwait that created some issues in terms of where some of the availability of light distillate is going to come from, so that'll be supportive of where storage is. Now, middle distillate, including obviously diesel and jet, rose 941,000 barrels a day, which is a reversal of last week's fall of 1.27. So again, not fully, but you're seeing some of this. We'll get a mixture of builds, draws. It's just that we're going to be heavier on the draw side versus the build side until some of this European product starts to show up as it's reversing the other way. And then Singapore, the 10 ppm, so that's just 10 parts per million sulfur gas oil cash differential hit a near 15-month high at the Asian close. So the cash differential has almost doubled since the start of the month amid a decline in the number of spot gas oil cargoes emerging in the market. So again, that's bringing that European product now into the area. And remember, about a month ago, we were saying that the ARB was open from Asia to Europe or Atlantic Basin. Now the ARB is open from Atlantic Basin into Asia. So you'll start to see some of those show up as well. Heavy resid rose 668,000 barrels. When you look at spot trading, you've seen some softness in flat pricing. So you're starting to see some of the heavy resids coming back in. It's going to be a matter of where does this product clear, because the lower end of the price range was for product deliverable from October 23rd onward. Same grade was assessed $613 a metric ton. October 19 down $7 per metric ton on the day. So you're starting to see some of these movements in general as they try to find that clearing price for very low sulfur, ultra low sulfur, high sulfur. And these are going to be some of these competitions as to who takes this product given their environmental restrictions. So when you look at global crude oil on the water, we're now back above the 5-year average and trending higher. This is going to be due to, again, that clearing aspect of Asia. Asia's taking in more of this product. So we will get a dip in Asian floating storage and then an increase as this product goes from crude oil on the water, crude oil in floating storage, again, waiting for that to be unloaded, which is why crude oil in transit right back to the 5-year average, as floating storage ticked higher again, remaining near the highs. Obviously 2020 is a unique period, but you can see 2020 has been coming down. And as we've been saying on the floating storage side, we expect this just to continue to be sideways and kind of waffle back within a fairly tight range outside of that drop, which was obviously caused, as we said, by the typhoons. So when we look at time spreads remain fairly fixed for Brent right here at about 68 cents. You've seen some of this competition back and forth, which has kept it fairly flat in terms of pricing. But then when you look at WTI versus Brent, WTI, essentially the pricing structure is blown out, where this is just showing you right now December versus December. So they're saying that the backwardation is this December is priced almost $10 above next December. So again, depending on how bullish you are on crude, buy next December, because that is the much better trade at this point, just given where some of these differentials are. But this is something where we expect this to collapse a bit, and it could be a fairly strong play if you were to short this December and buy next December and play some of this snapback. I think something closer to $8, so maybe collect $1.50, $1.75. When you look at Singapore, things are starting to get a bit more competitive when you look at some of the movements. Obviously, pricing is going to be difficult, as we showed last week. This is showing one piece of the orb, but when you factor in pricing, things aren't as rosy, but still better than they were, obviously. And just given where prices are on that middle distillate, heavier disti cut, you're going to see some of those benefits and some of those run rates remaining a bit elevated, as you can see here on the hydrocracking side. But remember, hydrogen prices are up, natural gas prices are up, so that has to be covered. It's still positive, but below the 5-year average once you factor in that in. But still, again, you're going to be incentivized to run. You'll see these guys continue to increase run rates. Europe is getting a bit more competition, which is helping some of their refiners because, Urals, Libyan barrels, CPC barrels, you're seeing a lot of these crude flows, which again is enabling them to maintain and increase runs. And that is in the Mediterranean as well as Northwest Europe. This is looking the Mediterranean, again, pushing back up, being supportive. Now, when you look at China imports, they have now spiked back up. We continue to see this moving up, again, very much along the 5-year average. Now that we've finally gotten those last leg of quotas, that'll pull in additional crude into the market. Then when you look at Asian floating storage remaining elevated, this will drop. So we expect to see this come down a bit and then spike back up. And again, it's just going to be, and when I say spike, just back to where we were, it's just we're going to get a fairly big movement down and then a movement back up. You had a quick movement because of issues in Hong Kong on a typhoon side, but then you also have some additional increases coming through and pulling additional product in. Now that you got your import quotas, you can move it from offshore to onshore, which is going to help, again, move that product through. And then at the same time, there's going to be that delay of when you imported it and then when you replace it. So that'll bring Asian down next week and then back up the week after. North Sea back to the 5-year average. We expect this to continue to grind up a bit, but nothing above where we are against the 5-year. Same could be said for Europe, but West Africa, we're now at the highest level we've been at in 2021. Seasonally adjusted, very elevated. And this is why we expect to see the IOC in India start to clear some of these barrels, because what we're hearing is that you're getting a lot of pricing incentives at this point to kind of clear this glut, because they're sitting here, we're at the end of October, and they're still sitting on a huge amount of November, and they're about to announce December, with Angola already doing so, and this is creating some concern. So you're going to see some of these barrels clear. Now, when we look at the Middle East, we saw the clearance in terms of some of these barrels coming through. There's going to be that timing delay of when some of them get loaded. They'll continue to go sideways, maintaining these levels as the IOC or India continues, starts to take these from floating storage into their market, from production straight into their market, which again is going to keep them fairly fixed, as Europe is going to trend a little bit higher towards the 5-year average. And then when we look at China, Shandong, again, remaining elevated, still just off the 2020 highs. And then when you look at fuel oil remains at 2021 highs and trending up, just given where the pricing metrics are and those quotas sit. So I know we covered a lot. If you have any questions, you can find me obviously on Twitter at MarkFNY or in the comments section. I apologize. I've been a little busy, haven't had a chance to go through the comments. I will circle back and cover all the ones that I've missed. And again, we always appreciate your support, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.